This is Larry Williams, and it's a real thrill to be back at StockCharts.com. In July, the end of July, I did my last show where I talked about, I thought stocks in China were going to go down, get body slammed, in fact, and we had a slide for that. And I found out two things. One, I was a little early in my prediction, but stock did go down. And also a lot of people said, Larry, that's not a body slam. You obviously don't watch World Wrestling Federation stuff because that's not what they call a body slam. So I learned a lot. That's not a body slam. And stocks in China, I use my Uncle Sam index. This is a fundamental tool. It's really interesting because it has been so good on helping us identify the major moves in China as well as Korea, as I pointed out. Now, this is a fundamental index. It's not technical. This has stuff to do with what really happens in China. It's a product of the Federal Reserve System. This is the forecast that you saw in July, unchanged. As you can see, the red line predicts in advance what should happen to stocks in China. It was suggesting stocks in China should go down. So the big question is, A, what happened? And B, what does it show now? What's next for stocks in China? And how good is this fundamental index? Well, here's how it came out. So stocks broke in China, big trading range, and eventually it started to come to the downside. It looks like now they are in fact in tune with the fundamental forecast from the Federal Reserve System. Interestingly enough, there's no turn to the upside in sight. My reading of this is that stocks in China will probably have a downward bias, but you see there's no massive decline coming, just more of a choppy trading range back and forth, maybe until after the election. And boy, do I have some great stuff to share with you about this presidential election coming up. So stay tuned for that. There's a lot of really strong trades coming up right around our election, and that may well influence stock prices in China as well. So we'll want to pay attention to that. We also forecast the same chart we showed in the end of July for Korea. Again, that same fundamental data influences the Asian markets quite well based on the Federal Reserve System report. And that was a forecast, but as they say, how did it come out? You know, in this business, you're only good as your last trade. And this is how it came out. Korea started to come down following the fundamental forecast, but it also suggests that, well, not a whole lot in store here. Downward movement clearly. You don't want to be long here. There's no big upturn in sight until the end of the year. So hopefully I'll be able to come back on StockCharts.com at the end of the year and update this. We get a better idea of what's next, if there is a next to the upside or a further continuation of the down moves for stocks in China as well as in Korea. So this is what's really interesting to me. There's this big point right now. There's a deep freeze in U.S. and China relationships. But, you know, we had the forecast in July that stocks would go down, and they have gone down. So what really controls? Does news control or do fundamentals control? And I think this is just another example that there are underlying fundamentals that really control what happens in stock and commodity prices. If you can get into these fundamentals, you have a lot better idea because you have perspective of where the market's going. It's not playing from one news story to the next news story, from Fox News to MSNBC News. You really have a perspective of what's going on in the marketplace, and you can see that perspective. Well, there's other things we can do. I now have my cycle forecast in StockCharts.com, and this gets really interesting. The cycle forecasted we should start a bit of a rally here, and we come down now just about where we're coming down. Was able to call this rally in here. Again, this gives us a forecast in advance. It suggests around the middle of October, we should see cyclical influences in China. Now we're looking at China. We will get to United States stock market, to gold, and to Amazon coming up shortly. But you can see the forecast is we should start to see a turnaround, a bounce at least in stocks in China. Another thing we can look at in China is to look at the true seasonal pattern. The true seasonal pattern right now is to the downside, flat for most of October, then later in November it picks up a little bit, which is interesting because the technicals are kind of telling us here that, yeah, fundamentals probably have a good picture here. There's no big moves in sight to this market. We're not ready yet. There will be a time for this market to rally. But what I found in my almost 60 years of doing this, The best trades are ones you wait for. It's like playing baseball. You have to wait for the right pitch. That's the one you might be able to knock out of the park. And the more stuff you have to confirm a trade, the better that trade's going to be. Here's another tool, my accumulation index. This is a measure of I believe, of actual professional buying coming into the marketplace. Notice at the lows in March this year in the Shanghai index, there was a big divergence. There was divergence at the top. We made a higher closing price, but there was no accumulation. There's no follow through, no buying on this rally. But by the same token, when we made lower prices down here, we didn't end accumulation. So there was strong holding of this market. It's no wonder it rallied. We see just the reverse at the top in Shanghai, where we see prices are going higher and higher and higher, but accumulation is going lower. In other words, people were distributing stocks. The professionals, the public isn't aware of this, but now that this index is in StockCharts.com, you can apply this to anything. Say, oh yeah, they're distributing, so I'd better be careful. Big takeaway right now, there is no divergence, no accumulation coming into this market yet. That may in the future, but right now it isn't, which would also suggest that probably there's more to the downside, or at least more time before we see any substantial buy point in Shanghai. Well, I told you we're going to talk about gold, so let's do that. Let's talk a little bit about gold now. Gold's been a big market all over the world. I have a lot of gold bugs that are friends, and I have some insights into the gold market I'd like to share with you. First is my weekly forecast. Just looking all the weekly data in gold going back the last 30 years, and we see that we should continue this little decline we've been in a little longer, rally up to the end of the year. Then after the end of the year, we come down, and there's the next really good buy point in gold probably coming in March of this coming year. And notice that from here to here, nice buy point, good buy point. The next one's coming up. So trading range, downward bias in gold between now and somewhere around March timeframe. If we look at the true seasonal that's in stock chart, we see another interesting picture. We see that the seasonal pattern of gold has usually started to come down and drift down now until around the end of the year. This tells me as a trader that the trading strategy in gold, I'm looking at the ETF for gold, GLD, I want to sell rallies. A rally, a 4, 5, 10-day rally, I want to sell because most likely prices seasonally have gone to the downside at this time of the year. And if we look at the seasonal for the cycle, the cycle forecast, we also see the same thing there as well. So a downward bias in gold. You know, the public has gone crazy with gold. Oh my gosh, you go on the internet, all the right-wing radical people are saying buy gold, it's going to go up forever, da 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 da. But here's reality. Here's really who's really long, who's really short. The public, this is the from the Commitment to Trader report, these are actual positions held by non-reportables, the average trader in the street. And notice they're heavily long gold, and typically when they're heavily long gold, gold has come down. The red line is the commercials, the people that use and produce gold. Again, this comes from the Commitment to Trader report, and these are real numbers. This is not just some indicator. This is the net number of contracts they actually have in the marketplace. And we see a huge rally in gold started back here, and look who was heavily long. Commercials were long gold, as they were over here, as they were here. Now they've been on the short side of gold. Since they don't make their money trading the market, they are hedgers. They may be early in a move, but when they get aggressively short, as they were here, look what happens. The price of gold goes down. Back here, price of gold goes down. So they have been heavy sellers in this market, and I think that's certainly a negative indication for us that we would expect gold to follow the seasonal pattern, because there's a fundamental reason for it to follow the seasonal pattern or any cycle projections that we have. The public is just way too long this market. And as you can see, when that green line is high, typically the price of gold goes down. We can also look at StockCharts.com and look at my indicators there to see what our cycle forecast says in StockCharts.com. Done a pretty good job. We should rally point here, rally point here. And the cycle forecast also now says that we should start to come to the downside. We're looking at a weekly time frame here. More importantly, perhaps, we can actually look at my representation of what the commercials are doing in the marketplace on a weekly basis. And notice when this line is high, the commercials are buying in my book, and they're selling over here just before the big break. They're selling here. Well, recently at the high, they were selling. The big takeaway here is they're not in the buy point yet. Now you can follow this on StockCharts.com. You can see when they get into the buy area, that's when I'll be interested in buying. But until I see what I'd call smart money, the commercials on the long side of this market, I really don't think that I want to be in this market because I see that these guys are almost a controlling influence, you could call them, of the marketplace. And when they get aggressively long like that, I want to be in sync with them. And when they're not aggressively long, I want to be in the other side of the market. In other words, it gives me perspective. Now, here's another really neat thing you can do in StockCharts.com now. This is a 15-minute forecast, cycle forecast. Notice that the red line projects into the future. So this turning point was known. This turning point to the downside, this little rally was known about a day and a half before it actually took place. The sell-off we see here, well, you can see price generally follows this intraday forecast. So if you are an intraday trader, and I'm not, frankly, I want to capture big moves in the marketplace. So I look at the market on an intraday time frame, but I'm not a serious intraday trader, but I think that's a very difficult way to make money. But if you are an intraday trader, that's really a great tool to give us an inside look into what's going on in the marketplace. So you can look at that. And so you see what happens. There's forecast for gold, 928, we should come down, bounce a little bit. And then late on 929, we start to drift back down. It looks like a buy point coming up about the middle of the day on the 30th, one of my daughter's birthdays. Okay, now let's go to the United States stock market. Oh my gosh, there's so much going on in the stock market right now. But as always, what really counts is what the smart money is doing. We all think we're pretty smart because we're traders, but you know what? We're not that smart. We all have these books, and there's all these gurus out there telling us what to do or what not to do. Everybody has a theory, but the reality is, who's really buying? Who's really selling in here? I think that helps us a whole lot more. So we can look at commercial buying or selling in the marketplace. We're looking now at a weekly chart of the triple Qs, the stock market. Notice when our index in StockCharts.com is high, the commercials have been buying, even at high price levels. When it's low, they've been selling just before the big break this year, before the break in 2017, 18, before the break in April in 2019. Look where they were. Well, they recently moved over to the sell side. This is kind of like what we saw in gold. What am I waiting for here? I'd like to be a buyer when the commercials are a buyer, right? Does that make sense to you? Sure does to me. So I'm going to keep my powder dry most likely until I see commercials buying. Once commercials inform smart money move over to the long side of this market, then the technical buy signals will work, whether it's a candlestick that some people use or a moving average or point and figure. All the technical mumbo jumbo really doesn't work very well until you put it into context. And the context is what's critical. Those things work well when the commercials are buying. They don't work so well when the commercials are selling. So what we want to do is wait until we see the commercials in that buy area. We're not there yet, but we can measure it. We can watch it. When they get there, that's a question. Well, when will they get there? Let me give you my idea of when that's probably going to happen. We can look at accumulation coming into the market as well. Notice that the accumulation technique I just talked about earlier, we get big divergences. Notice we made lower lows this year. Those who watched my stock chart presentation in March this year, now I was outrageously bullish, said we had bottomed. We had our ultimate panic buy signal and stocks have gone to new highs. Well, look at the accumulation that came in there. When price was going down, smart money didn't sell it commensurately, did they? Or again here, lower lows in price, but not over here. Finally, we got some divergence in the market and it started to come down. So what I'm looking for now in part would be to see some distribution in this market, to see the market start to make lower lows, but not see lower lows in our accumulation distribution. That's what I really want to see. Now, will that take place? No, nobody knows if that will happen or not, but that's certainly what I'm going to be looking for. That's the next thing to look for. As this stuff comes together, people just rush into the market. That's not a very good way to go about trading. What you want to do is really take your time, wait for all the elements to come together. One of those elements would be what cycles say. And we're looking here at a 72-day cycle. That's been the most dominant cycle in the S&Ps. Notice it was close to the low here, good buying point here, good buying point in June 2019, August a good buy point, last October a good buy point. Pretty good, huh? So what does it look like now? Well, here it is now brought up to date. There's that 72-day low at the March lows, another nice buy point in June, the last big rally in August. And my cycle study suggests about the 20th of October, we're going to see a bottom in this market, a good buying opportunity. So now I can start to put all this stuff together. What I love to do is help people and teach people how to trade. And it isn't just one indicator. It's like, yeah, we wait for this to happen and that to happen. We know we're coming into a cyclical low. We can watch to see when the commercials start buying. We can look for some accumulation distribution in the marketplace or some divergence in the marketplace. Then we can get ready for a trade in the marketplace. That's based on the technical aspect of the market, but I also believe that the fundamental aspect of the market is equally important. So in my work, I think both matter. A lot of people just say, oh, fundamentals don't matter. I think they do. And here's the big difference that I'd like to share with you. Fundamentals give us the broader sense of the market when the market is set up to move. Technicals give us a more specific timing. I think technicals are pretty good for timing, but they're not really very good for giving us a broad perspective of when a major move is going to come. So what's going to do that, I think, are fundamentals. And I believe fundamentals still do matter, really matter. So how do you measure fundamentals for stock market? That can be tough. Well, actually, there's several ways you can do that. I'd like to share one of those with you today. And that's simply going to be look at interest rates. Clearly, interest rates have an effect on the economy. When interest rates are really high, when Jimmy Carter was president, what was the economy like? A disaster. What was the stock market like? A disaster. When Ronald Reagan was president, we eventually got lower rates, or when Donald Trump was president, we got lower rates. Oh my gosh, look what the stock market did. So yes, clearly interest rates have an influence on stock prices. And what I found, we're looking at a weekly chart here. What happened in interest rates about 2 years ago, 110 weeks, let's call it that, a pretty good indication of when we can look for rallies in the stock market. So this blue line you're looking at, this low or a buying opportunity, was known 2 years earlier. That we should sell off from here to here was known 2 years earlier. This peak forecast in 2018 was known 2 years ago. In other words, this blue line is pushed forward. So you see, we want to be a buyer here, maybe we got a buy coming up. We'll look at that chart next. But this has been a pretty good leading indicator of what's going to happen to stock prices. Here it is pushed forward again into this year. Notice that interest rates did call that bottom. We looked at it in the last chart. Back here, we're seeing what's going to happen, right? There it is. This low is known 2 years in advance. This buy point here, 2 years in advance. The market top, 2 years in advance. So where are we now? What's happening now? This is where we are right now, up to date with what I think the influence of interest rates on stock prices is. 2 years ago, we saw that prices start to come down, rally up about where we are now, come down again. And at the end of the year, this influence of interest rates start to pick back to the upside. And we should expect a pretty good rally based on interest rates in 2021. Maybe. There's still other fundamental things to consider, but there's a fundamental backdrop here that we may have a pretty good rally at the first of 2021. I'm going to get to that in just a little bit. Because another thing that can forecast stock prices are energy prices. I mean, you know, there's gold and there's black gold, crude oil, and certainly every country in the world is trying to get energy and either save on energy or produce energy or go to solar. I mean, it's a huge battle going on in the world right now. In this case, you're looking at energy prices pushed forward about 70 weeks into the future. And you can see that's been a pretty good harbinger of what's going to happen in the stock prices, which would suggest about now we come down, then around the end of the year, we start to rally and into the first part of 2021. So isn't this nice to have a clear view of the picture, not based on some mumbo jumbo lines of trend lines projected into the future or something like that, but real fundamental stuff that really matters? Wow, that really gives a much better sense of traders of how we can act in the marketplace. Well, interest rates affect stock prices too. I thought you might get a kick out of this. So this is a chart that I showed in my weekly forecast. I could do Larry TV a couple of weeks ago. The blue line is interest rates. The black line is Amazon. And our forecast suggests that Amazon's going to start to go down a little bit here, right? See, that's forecast into the future. And how did that pan out? That's always a big question. So let's take a look. This is what happened to Amazon. Look at this. Amazon started to follow the fundamental forecast based on interest rates. So fundamentals really do matter. Things do matter. We can take another look at Amazon and go back to our seasonal pattern as well. This is the seasonal pattern for Amazon in StockCharts.com. You can see typically Amazon comes down until somewhere November, December, and then it starts to move to the upside. So you can get a sense of what a market's going to do by looking at seasonal influences, at fundamental influences. And if you want to go to a real short-term basis, here's the 15-minute forecast using my cycle forecast index that's in StockCharts.com. See how the prices come down pretty much what the projection calls for. So that's a real close-up and personal view of stock prices. Okay, so that gives some background on indicators, but the big one's coming up. The election, who wins? What does it mean? Oh my gosh. Do I have some information for you? This is just, I just love to share this stuff. Pre-election years, that's like the year in right now, have not posted a losing year going all the way back to the 1930s. Even with COVID, with all the problems we've had this year, what are stock prices doing? It's a pre-election year. Stocks they're going to be higher. And one of the best buying opportunities of the last 10, 15 years was this year in March. So that's one bias that shows you that election years do matter. They do make a difference. Well, how about who wins? Does a party matter or who wins matter? Look at this. If the incumbent party maintained their office, in other words, they won the re-election, the average change was up the next year 9%. If they lost, it was minus 6%. So let's look at that. The S&P has stumbled the most in post-election years when the incumbent party loses. Since 1930, those years average a median loss of 6.62%. Boy, there's a wake-up call. If Donald Trump loses, we're probably not going to have a good year in the market in 2021. So, but what if Donald Trump wins? Well, and it doesn't matter if it's a Democrat or Republican here now. This is when the incumbent party wins. They stay in power. Since 1930, those years have averaged a gain of 9%. What a difference between who wins and who loses. So as investors and traders, we want to pay a lot of attention to what's going on in this election. Elections really matter. This is the average price of all election years from 1878 to 2016. There's election day here. On average, shortly before the election day, we've rallied in every election year. On average, that's the pattern that's taken place. And that's about what the pattern is this year. However, we can break that down. This is when Democrats have won. This is what's happened when Democrats have won. We've got a rally just around election day. You want to look to go long. It rallies for 3-4 days. Then it comes down and later on starts to rally again. So if Biden wins or you think he's going to win, that's your roadmap. That's your strategy. If Donald Trump is reelected, then we have a little different pattern for the Democrats. When Democrats win, what we typically see is a much stronger rally starting before the election. In fact, look at this. This is probably going to tell us who's going to win the election. If we are higher in October than we were in August, probably going to be a Republican victory. If we go back to Joe Biden, and go back to our Democratic chart, here we go. If we're lower here than we were here, that's probably a Democratic victory. If the market can tell us the future, well, that's probably the lesson we want to look for. Okay, this may also give you a little background. Every year I do an annual forecast. This was my 2020 stock market forecast. We should come down until about March, start to rally up. And that's pretty much what we've done. It also suggests we come down about now and should finish the year with some rallies. So that's the forecast we did in 2019. Pretty well follow that forecast, which tells me that there's no big massive decline coming. The end of all declines, the COVID decline, all the bears that are out there. There's a time to be bearish. Well, clearly I've been very bearish at times. This is not one of them. You can also go to a 15-minute stock market forecast if you want to, now that we have that also in StockCharts.com, and you can see how that looks. And again, it's nice because you get a pretty good idea. Oh, start to rally in here, start to come down here, start to rally up here. And all this, of course, is in StockCharts.com. The thing I think that you really want to pay attention to coming up is the election. I'm going to go back to those charts again and try to drive that point home to you. This is the average election year. So shortly before the election, that's the little reddish line right here, prices rally. That means at the end of October, there's a real strong buy point coming in the market for at least short-term, if not intermediate-term traders. The way we're going to trade that, to really isolate and say, is this a really good trade or not, is look at, are we lower or higher than prior points in that trend? If we are a lot lower than we were in September, we're probably going to see a Biden victory, a bit of a rally, not a real big rally, but a bit of a rally. If it's going to be Donald Trump, we should see higher prices at the end of October than we saw in August, and that would suggest a Republican victory. Again, that's based on the theory, as some technicians believe, the market knows everything. And sometimes it does, sometimes it doesn't, but that would certainly be the pattern we want to follow this year. Well, if you'd like to follow me, you can do that. You can come trade with me. I do my ireallytrade.com Larry TV, a weekly commentary. You subscribe to it on a monthly basis. You can go to ireallytrade.com. That is our website, and learn more of my tools. Are now almost all my tools are in StockCharts.com, so you want to go and look at that as well. I'd like to thank you for being here today. Feel free to share this presentation, and if you do it on YouTube, give me a thumbs up, or if you don't like it, give me a thumbs down. But above all, what I want to say to all of you, it's been a joy being here. Thank you, StockCharts.com, for again having me, and good luck and good trading to all of you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.